Welcome, crypto-curious explorers, to the deep dive. Today, we are leaving the land of Twitter hype and, those YouTube moonshot predictions. We're leaving all that behind.
They have to.
Our mission is not to talk about how to get rich quick. It's about putting on the lab coat and acting like forensic scientists in the digital world.
It's really time to professionalize the analysis.
Yeah.
I mean, if you were buying a traditional company, you'd pore over the balance sheets, right? You'd analyze the competition, vet the management team.
Of course. You wouldn't just trust some stranger shouting stock tips.
Exactly. And yet, in crypto, millions of dollars are still deployed based on, well, pure social media speculation.
And that's the core issue, isn't it? We're dealing with a market that, academically speaking, is often highly inefficient and just sort of deeply speculative.
It is.
But, and this is the reason we're here, beneath all that noise, there is real technology. There's genuine identifiable value. We just need the right tools to find it.
And our mission today is precisely to arm you with those tools. We want to move you from let's say, a gambling mindset to an informed investment mindset.
So what's the roadmap?
We are going to tackle what I call the trinity of analysis. That's fundamental, on-chain, and then technical and sentimental. This structure is your shortcut to separating a viable long-term project from, a house of cards.
Okay, let's jump straight in then. Pillar 1, fundamental analysis. This sounds like the search for the project's soul.
That's a great way to put it.
We're assessing its intrinsic health, asking that basic question, does this thing even deserve to exist? And the first stop, I assume, has to be the white paper, the project's constitution.
Absolutely paramount. The white paper sets the mission. We have to assess, does it solve a real existing problem, or is it a classic case of a technology just desperately looking for an application?
And there's data on this, isn't there?
Oh, yeah. The academic data here is, well, it's brutal, but it's necessary context. Studies that track the performance of initial coin offerings ICOs, they show that white papers with obvious plagiarism or just filled with unsubstantiated technical jargon.
Buzzwords.
All buzzwords. They have a failure probability exceeding 80%.
80% within how long?
Within the first 2 years.
Wow. So that is an immediate filter. If the technical claims just sound like, I don't know, proprietary decentralized quantum ledger scaling or something.
Right.
But there's no GitHub activity, no verifiable testing to back it up, you should just move on.
Precisely. And then beyond the document itself, we have to scrutinize the human factor, the team.
Okay.
I mean, while the whole historical success of Bitcoin lies in the mystery of Satoshi Nakamoto, modern, let's call them corporate-style projects, they demand transparency.
We need to know who is behind the wheel.
Exactly. What's their track record? What's the governance structure for making decisions down the road? Accountability is really the bridge between a cool tech demo and a functioning business.
But the true financial heart, the engine room of any project, has to be its tokenomics.
100%.
This is the engineering of supply and demand, and I feel like if you fail here, it's a death sentence no matter how good the tech is.
I see two huge structural risks that we have to look at right away. The first one is about supply dilution.
This is critical. You have to compare the circulating supply against the total supply.
Okay, why?
Because if a project boasts a low market cap, but only, say, 5 or 10% of its total tokens are actually circulating, that is a massive future risk.
Because the other 90% is just waiting to come onto the market.
Exactly. It represents enormous future inflation risk just waiting to crush the price. It's this huge overhang of potential supply.
So that risk means that even if the community buys in today, the founders or the early investors could eventually just dump massive amounts of tokens on everyone else. So how do we track when those tokens get released?
That's a second risk. The vesting schedule. I call it the emission calendar.
This tells us when early investors, the team, or the treasury are allowed to unlock and sell their tokens. What we're really looking for is something called a cliff vest.
A cliff vest?
Yeah, where maybe 0 tokens unlock for the first year, and then on day 366, boom, millions unlock all at once. Knowing those dates is just informed self-protection against predictable supply shocks. If a major vest is happening next week, you need to expect massive selling pressure.
That's a key actionable takeaway. But how difficult is it for the average person to find these vesting schedules? Are they public?
They should be. If the project is serious, the vesting details will be laid out clearly in the white paper or on their foundation's website.
And if they're not?
If you have to dig through obscure forums, or if the team is cagey about providing a clear emission calendar, that is a gigantic red flag. It just shows they may not prioritize transparency with their own community.
Excellent. Okay, let's transition. We've looked at the project's internal health with fundamental analysis. Let's move to pillar number 2, on-chain analysis.
My favorite part?
This is where crypto analysis really separates itself from traditional finance, isn't it? It's like a polygraph. Everything is public, verifiable, and immutable on the blockchain. We can actually use data science to measure network health in real time.
And we can rely on some really foundational concepts, like Metcalfe's law. It suggests that the value of a network is proportional to the square of its connected users.
So, vale vile propto n22.
Exactly. We can't just rely on market cap alone. We have to measure the actual activity that justifies that capitalization.
So, if the law dictates that network value comes from usage, what's the first metric we should use to measure that usage directly?
We have to start with active addresses. This tracks the number of unique wallets that are sending or receiving value on a given day. We're looking for genuine utility here. Are people actually using this system for payments or DeFi or whatever its purpose is?
And this is where we can spot bubbles, right? When the price goes up, but the number of users stays flat.
That is the textbook definition of a bearish divergence. If the price of an asset is skyrocketing, hitting higher highs, but the number of active addresses is flat, or even worse, decreasing,
Oof.
it tells you that the price appreciation is driven solely by hype, by speculation or bots, not by real organic network growth. It's just not sustainable. And historically, it's a very strong pre-indicator of a bubble about to burst.
That makes the data instantly actionable. Okay, what about for decentralized applications, for the DeFi world?
For DeFi, you absolutely must look at PVL, or total value locked. This measures the total amount of user money, the crypto assets, that has been locked into the smart contracts of that protocol.
So it's kind of like deposits in a traditional bank.
It's the closest equivalent, yes.
And why is a high TVL so important? It doesn't just show that the money's there, it shows faith, right?
Exactly. High TVL indicates two things. One, user confidence in the protocol's security, and two, strong demand for the yield or the utility that protocol offers. If a DeFi platform has this massive market cap but a tiny TVL, it suggests users might like the token, but they don't really trust the code.
Now let's look at the grand synthesis metric, the NVT ratio, or network value to transactions. This is where the price really meets the utility.
The NVT ratio is often called the price to earnings, or PE ratio, of the crypto world.
And how do we calculate it?
We just take the market capitalization and we divide it by the daily transaction volume. It forces us to ask the question, are we paying too much for the utility we're currently getting?
So let's break down the interpretation. If the NVT is very, very high, what does that suggest?
A high NVT suggests the network is dramatically overvalued relative to its actual transaction use. The market is pricing in huge future growth that just hasn't materialized yet. It's a strong indicator of a potential bubble.
And on the flip side,
conversely, a low NVT suggests the usage is high relative to the current market cap, which might indicate that it's undervalued. It's a crucial sanity check that forces you to look past that big market cap number and ask, is anyone actually doing anything useful here?
that forces discipline. It really prevents you from getting caught up in the hype just because the price is moving fast. Okay, now we move to our final pillar, technical and segmental analysis. We're shifting gears here from intrinsic value and verifiable utility to, well, to managing probabilities and understanding the crowd. The crypto market is intensely emotional, and those emotions show up in the price charts.
And managing probabilities is the key phrase there. Since this market is so driven by retail excitement and panic, we can start with sentiment tools like the Fear and Greed Index.
Right.
We track this because, as Warren Buffett wisely said, the wisdom applies perfectly here. Be fearful when others are greedy, and greedy when others are fearful. When that index is flashing extreme greed, it often signals a psychological high point, and caution is definitely warranted.
So sentiment helps us measure the emotional temperature of the market. Technical analysis, then, gives us the map for navigating that emotion. The listener doesn't need 50 complex indicators, do they? We just need the foundational structure.
Absolutely not. Start with market structure. Simply identify the trend. Are we setting consistently higher highs and higher lows? That's bullish. Or are we failing to make new highs and setting lower highs and lower lows? That's bearish. That foundational identification will manage your risk better than any complex system.
And beyond just the trend, what's a simple tool that helps define entry and exit points?
That would be support and resistance. These are just price levels where historical buying, that's support, the floor or historical selling, that's resistance. The ceiling has been really strong.
So you don't buy when the price is hitting a ceiling.
You don't. You wait until it either breaks through that ceiling with conviction or it drops back down to a strong floor. It helps you manage where you buy, not just what you buy.
That brings us to volume. If a price breaks above a major resistance level, but the trading volume is super low, that should worry us, shouldn't it?
A breakout on low volume is often called a fakeout. Volume confirms the conviction behind a price move. If the price rises dramatically, but very few people are actually participating, it suggests the move is fragile and it could reverse very quickly.
You want to see high volume.
High volume confirms that a new trend or a breakout has broad market participation and is, much more likely to be sustained.
Now, we've mentioned manipulation a couple of times. When we talk about the limits of technical analysis, we have to talk about whales. Who are they, and how do they sort of undermine our probabilistic models?
Whales are simply massive holders, usually early investors or institutional players. They own enough of an asset to move the price significantly just by executing one large buy or sell order.
And that's the warning.
This is the scientific warning, yes. The efficient market hypothesis suggests past information doesn't always predict the future. And that's especially true when large players can intentionally liquidate large orders just to influence the emotional response of the rest of the market. Technical analysis gives us a playbook, but it's never infallible against determined manipulation.
Okay. We've covered the Trinity fundamental, on-chain, and technical sentimental. Now let's condense this all down into a survivor's checklist and the necessary sobering warnings.
First, utility reigns. Only projects that solve real problems survive the long crypto winters. We call this the Lindy effect. The future life expectancy of a technology is proportional to its current age. If it's survived and thrived for 5 years, it's far more likely to last another 5 than some brand new project.
Second takeaway, on-chain is the polygraph. Price can be manipulated by hype cycles or by whales, but the underlying activity on the blockchain, that verifiable data on active users and TVL, that rarely lies about genuine adoption.
And third, diversification is the shield. The volatility is just. It's too high to rely on a single project, no matter how good the fundamentals look. You have to spread your risk across multiple fundamentally sound assets.
And speaking of risk, we have to be brutally honest about the dangers that you, the listener, must accept, even if you execute all 3 pillars of analysis perfectly.
The first, and maybe the most unpredictable, is regulatory risk. A sudden, unexpected change in U.S. or EU law, maybe defining a widely held token as an unregistered security, can immediately collapse a fundamentally sound project overnight. You can't analyze your way out of a political shift.
Then there's the code itself. You can have the best team, the best white paper in the world, but if the code is buggy, it's all for nothing.
That's the smart contract risk. The smart contract is just self-executing code on the blockchain that controlled funds. If there's a bug or an exploit in that code, all the money locked in it can disappear instantly.
And audits don't always catch it.
Auditing services like Certic are mandatory to check, but they are not infallible. The history of crypto is littered with examples of auditors missing critical exploits.
And finally, that stomach-churning volatility. You have to reiterate just how extreme it is compared to traditional markets.
The data clearly shows that crypto has a standard deviation, our measure for volatility, that is multiples higher than the S&P 500. And this is the final, crucial warning. You must only invest capital that you are prepared to see fluctuate by 50% in a single day without having a catastrophic emotional or financial reaction. Discipline is everything.
That is the informed 3-pillar framework we set out to explore. We've gone from speculative guessing to professional analysis. So our challenge to you tonight is simple. Go look up the NVT ratio for your favorite project. See if its valuation actually aligns with its real on-chain utility.
And here's a provocative thought for you to explore before we go. Given the mathematical verifiability of on-chain data, how might future government regulation use the specific metrics we discussed, like active addresses or total value locked to, definitively distinguish between a legitimate utility asset and a regulatable security asset in a courtroom? That bridge between data and law is where the next major crypto battle will be fought.
Food for thought indeed. Thank you for joining us for this deep dive into the mechanics of professional crypto analysis. We'll see you next time.